Hello, everyone, and welcome to another episode of Upstream with RiverX. I'm your host, Kieran Berry. Today, I'm joined by one of our advisors, one of our financial advisors, Scott Taylor. Scott, thank you for coming on today.
Thank you for having me, Kieran.
And before we jump into it, it's important that we go through our terms and conditions. Anything that we say or discuss here today is not financial advice. It's for factual information only. We do not know what your personal circumstances are if you're one of our listeners, unless you're a client of the firm. So if you do have any questions about the matters we discussed today, please reach out. You can reach us at www.riverx.com.au. Scott, myself, or one of our team will be here to help. But mate, again, thank you for coming on, taking some time today.
Yeah, my pleasure. Thanks for the invite. Really appreciate it.
And for the benefit of our listeners, can you give us a rundown about sort of who you are, what you do, and your background and education before joining RiverX?
Yep. So Scott Taylor, financial advisor, private wealth advisor at RiverX. Predominantly my experience to date has been more in the retail space, holistic advice space, which I'm really passionate about. And up until now, look, I've been, out of uni, sort of honed my skills from the early 20s as an advisor, did junior roles at one of the major banks, starting predominantly in risk. And as time's progressed, I've, sort of been able to, hone the skills and progress from there. So.
And I've seen with the clients you deal with that you have deep relationships with those clients. When you're working with those clients, how do you normally service them? Is it risk? Is it super? Is it personal advice? How do you help them?
Yeah, so as time's progressed, I'm in my late 30s now. I've been advisor 16 years. So what I've really found is that I've sort of gone more to the pre-retirement space. So how I service them is I want to be me still. So I want to be authentic in what I do. We have all the technical knowledge to be able to help them with, legislation and what it means for them, taking into account their personal details. But at a core, people want to deal with people and people want to be understood. And I also want to understand them on a personal level, what they're looking to do.
And one of the things that's been really topical of late, and the reason for getting together today, is to talk about superannuation. What is it? How does it work? Proposed changes and what's on the horizon? Because it's been all over the papers. People are thinking, what does it mean for me? So we'll jump in and unpack each of those various bits and pieces. But just at a high level, it'd be good if we could give the listeners a bit of a grounding about, what is super and why do people talk about it so much?
Sure. So superannuation is a tax structure so that people can accumulate savings and wealth so that when they're not working, they're able to live a good lifestyle and draw down on those funds when they don't have an income. It sometimes gets associated with being an investment on its own, but at a very core level, it's a tax structure. So in accumulation, earnings are taxed at 15%. If you hold certain assets for a period in excess of 12 months, capital gains can be taxed at less than 15, so at 10%. So there is some good concessions there. Investment choice and superannuation, two separate things. So the breadth of what people can do is ever increasing. Sometimes people don't understand the options that they actually have. Talking platforms, investment options, different structures, which I'm sure we can go through. Mm-hmm. But at very basic core level, it is a tax structure.
Mm-hmm. Okay. And I mean, the tax piece, that's why all the accountants I deal with seem to love it and talk about it. Mm-hmm. When someone comes to you and they say, look, I've got some questions about my superannuation, can you take us through your general process when you would meet with one of those people? Like, what would you need to get from them to assess if a self-managed super fund is appropriate for them?
Yep. So we would go through some baseline qualifying questions. So we'd start with just trying to understand, where they are in their understanding of what super is. So do they understand things we just spoke about around taxation of super, investment options at a very basic level? And what decisions have they made thus far? So how engaged are they in their super? Mm-hmm. Generally, maybe younger people might not be as engaged because the time frame to utilisation is a lot longer than someone approaching retirement. So we'd sort of start with that, then the next step would be going down, their personal circumstances, like what have they got, what do they desire, preferences. That then leads, down the personal advice route.
Mhm.
But at the start, it's just understanding where are they at with their knowledge level before we start discussions around potential options or advice.
And at what point or threshold would you say it would be appropriate for someone to contemplate something like a self-managed super fund, which has a range of other costs associated with it? So let's just say I'm someone who's been in a retail fund. I've been working as a PAYG employee, and I've now reached a time where I'd like to take more control over my investment selections. What are the general thresholds as a minimum to contemplate a self-managed super fund?
Yep. This is not advice, but for me, $500,000 plus starts to make sense. So there's a scale question. Costs are fixed. So if you don't have sufficient scale, then fees are very important. It can erode capital significantly if fees are too high. Mm-hmm. There's a lot of literature out there to sort of back that point up. Mm-hmm. So for me, $500,000 plus. Preferences and the dynamics definitely change with a self-managed super fund. So you've got trustee obligations. Does someone are they prepared for that sort of level of complexity and risk as a trustee? Do they actually need it to facilitate the strategy that they want? Mm-hmm. So sometimes it may lead from the opposite way. So what I mean by that is people are coming with the solution first, not with the objective. So we'd like to sort of bring that back to basics to go, what are you trying to do? And then the question of, do you have enough scale and does that make sense, or is that door open or closed? Mm-hmm. is very different than what are you trying to achieve? Mm. So otherwise, look, there's other potential options in the market that are potentially more cost effective. If you don't need that level of control, maybe you don't want to buy a specific asset that you can't buy in a retail fund. Mm-hmm. So you have to have an underlying purpose for it.
Now, one of the purposes we've been presented with, and you were present, was we've seen obviously cost of living in Australia has gone up, cost of real estate's gone up, and Australians have an affinity with residential and commercial property. Yep. Is superannuation or self-managed superannuation a vehicle where someone could buy an investment property?
Yep, most definitely. So overwhelmingly, that's the trigger for a lot of people. The question of, do they have enough scale? Does it make sense? If they come to an advisor and if they're a retail client, then we have obligations on us to make sure that we are able to put that person in a better position, meet their objectives. So the $500,000 is there for a reason, to protect people, so that they're going into these things with and able to achieve the outcomes that they need, net of all costs. So that's it. It's just important to note that. They can buy various different types of property. So the most common we'd see, and I'm sure you'd probably back me up on this, is residential. Yep. So there's certain specific guidelines on the lending side, very much different to personal lending for home loans. The other instance where we would see it is business owners that want to potentially buy their own commercial property that they may conduct business in, and the business rent that out, and it's also an appreciating asset in their super fund. So, yeah.
And how would one get to the level? Because obviously you mentioned there's different lending standards in terms of deposits required, ability to make repayments. That's all different because you've got your contributions that come in, and then that's how you sort of service those loans if they're or those facilities if they're untenanted, for example, if they're not cash flow positive, for example. Yep. How does one get capital into super?
Yep. So, firstly, if you are employed via a salary, so you're a PAYG employee, mandated 12% minimum, super guarantee contributions. So that's the main form of how people will sort of grow it. On a personal contributing level, there's two different ways that you can contribute, pre and post-tax, or concessional, non-concessional. The caps are different. One's less, one's more. The more tax-effective solution is less, and the personal cap, non-concessional, is larger. Yep.
And in terms of the amounts, I mean, I know that, let's say, and this would be relevant to a lot of the small business owners that we have, If you're a business owner and you have not made contribution for a period, what's the maximum catch-up period you could have?
Yep. So the concessional cap, 30,000 a year.
Mhm.
Non-concessional, 120 a year.
Mhm.
Where you're not claiming a tax deduction. It's just personal money that you've, from bank account putting into super. So 120. On the concessional side, there is the ability to catch up for up to 5 years. So the current year and going back 4 previous, whatever is unused. So if there's no contributions, effectively you can use all of them back to 5 years if it makes sense. If you've used partial, then you can sort of pick up the pieces of what hasn't been used over those 5 years and make a one-off contribution if that was the right thing to do based on your situation.
And so you got the catching up aspect of it. And what about the bringing forward? Are you able to bring forward future years of concessional and non-concessional contributions?
You can bring forward non-concessional. So right now the cap is 120,000. So you can effectively bring forward the next 2 years. So 120 by 3, 360. However, that prohibits you from the current year and the 2 preceding because you're doing them all at once in lieu of the next 2 years. Yep.
Yeah. So it's one of the things we've been seeing is someone will come to us and say, look, I'd like to buy an investment property, for example, and then we have to contemplate the concentration risk within that book and serviceability and all the different elements that are associated with that.
Yep.
How would you normally navigate that? Would you have, let's say someone comes to you and they have an SMSF and they're looking to buy some property. How do you deal with that from a concentration risk standpoint?
Yep. So we would advocate for diversification for risk management purposes. So that's where it's very critical on like the scale that you have. Every situation is different depending where you're buying the property in. Anywhere around Sydney, if you needed 20% deposit plus legals, you're looking at a significant sum. But it's all about looking at, what they've got, what they're looking to do, modelling that out. Also the runway from where they are now till, when they retire. So even if they are a little bit more concentrated now, what capital is likely to come in so that we can achieve that level of diversification? The other thing, Kieran, is people don't understand until something goes wrong the issue with the concentration. So by and large, property is the Australian dream. It's done really well. There's no arguments there. However, if you happen to just invest at the wrong time in the wrong asset, wrong area, cyclical town, we've seen things go south quite quickly.
Yeah, I think that's why it's important to have a bit of a spread and a team that you can lean on. Yeah. And in terms of super as well, there are other elements to it. It's a complex product, but the other elements to it, aside from the legislative changes, which we'll get to, are things like the binding death nomination within super. So it might be beneficial just to talk through how that works. Like, so if you don't have it on there, what are some of the downfalls associated with not having a binding death nomination on your super?
Yep. So if you don't have one, effectively, your wishes may not be granted as to what happens with your assets. It's completely at to trustee discretion. So we would always advocate for a strong estate planning solution. So we're not estate planning lawyers. As the architect of your finances, being the advisor, we would look at that. We'd identify there's a shortfall there. We'd make a recommendation to address that through an appropriate nomination. Super pension funds, a little bit different. So on a super fund, you have either non-binding or binding. On the binding side of the nomination, there is only certain people that you can nominate: spouse, partner. So spouse, children, financial dependents, or someone that has an interdependency relationship. Or you can nominate, push the money to your estate.
Okay, so we're talking about passing on wealth, and we've also talked about building wealth and getting it cash into an SMSF, which is, as you said, a much more effective tax environment. Then you've got a range of strategies available to you, and our listeners would know we've had an affinity with sort of alternative investments that sit alongside of our traditional investments. When you're looking at something like an alternate investment, does it make sense if you're looking at someone who's got a long time to maturity to contemplate longer dated investments? Would you look at things like private equity, commercial real estate, or would you stick to your sort of more vanilla liquid solutions?
No, most definitely. We have the ability to do that at River. I think that's a differentiating factor. A client can come to me and they could be a retail or wholesale client. They can get structured advice. They can still receive a statement of advice, and they can also get, all the best of the investment solutions that we can potentially offer. So yes, no, I would in the alternative space. I would offer that to clients on a case by case basis. The clients with it's still a decent runway to retirement, sort of minimum 5 to 10 years plus. Then there's time for these things to be invested, because quite often they can be liquid for a period of time. Yep. So it's important if you are approaching retirement that you don't have a one size fits all. There's no certain model per se that everyone goes into. There's still an element of it's still bespoke in some aspects.
So in terms of the growth of the investments that sit within that structure, are there any caps or limitations, or does the tax rate change if you hit a different threshold?
Yep. So there's a few. Our industry is littered with acronyms. So you got like total super balance, transfer balance caps. So we might just go through those in very basic detail. So in a self-managed super fund, you have an aggregated balance that will be split between the members. So proportional to whatever they've put in, with contributions, rollovers, etc. With a tax-free pension, so when someone retires, it's recently been indexed. So 1.9 million is what someone could push into a tax-free pension. Any amount above that can still stay in super, but there is some tax implications there. So it's not completely tax-free. So it's 1.9 each. The $3 million cap been quite controversial in the media. It's got a lot of publicity. So from this financial year, as of next, it's effective 1st of July 2025. So the $3 million cap. The big point in contention there is the movement in the balance, which effectively enables taxation of unrealized gains. So I know a lot of accountants, sort of up in arms about that, as advisors are as well. Maybe it's a bit of a prequel for maybe what's to come.
It seems like superannuation is an environment where you've got a huge accumulation of wealth, and the government is keen to put their hand to it through taxation or change in regulation in one way, shape or form. What do the new reforms mean? You mentioned that it's a taxation on unrealised gains above $3 million. So they'll be paying just the general CGT rules on every dollar above $3 million in their fund. Is that right?
No, so they'll pay, it won't be added on as personal income. It'll be tax levied separately to that.
Yeah, okay. Yeah. So when you're looking at someone's portfolio, again, not advice, but what strategies would you use to help minimize that? Would you look at things like private credit so you don't see growth and it's paying an income stream? Would you move amounts out of super and look at trust structures, for example? Obviously, case by case with each client, but there would be some general strategies that you could contemplate to help get you in a better position.
Yep, it's we're doing forward thinking now. It's just come in. So I think as more wealth grows in super, it'll become more common that these strategies will need to be implemented. I think every advisor will have a group of other professionals that they would lean on. So I would do the same. I would engage accountants or the client's accountant in particular. So we'd look at the different tax structures. What are they paying on a personal level? What have they actually got in super? So if they're over $3 million, what's their marginal tax rate personally? Do we look at discretionary family trusts where we can distribute income to maybe a spouse that might have a low marginal tax rate? But we need to stay in our own lane and not give tax advice. We look at an element of it, so we would engage their accountant and do it in conjunction with the accountant as well.
Yeah,
but I think we should be flexible and have all the options on the table. If a client is in that position, we should explore every avenue.
Yes, it sounds to me like you need to bring in a team when you're contemplating different elements of someone's financial affairs, because you've got accountants for tax, estate planners for estate planning.
Yep.
You've then got financial advisors for the bread and butter that we've talked about, and the holistic advice piece. When you're, I know when you're speaking with clients, you'd have a range of different professionals that you work with. But how does it generally work for you? Is it a conversation with the accountant first, as that trusted person who oversees all their financial affairs, or is there someone else within the network that you normally get to know before a client, if we can really get to know the client's circumstances?
Would generally be the accountant would be the go-to person, sort of the gateway to their finances.
Yep.
If they have different structures set up, sometimes a client can articulate, well, why do you have a family trust? Why do you have a separate company? And quite often they can't, or probably more often they can't. It's just because I was told that I needed it to reduce tax. But the meaning or the purpose behind it, and then the utilization from a strategic point of view, is where we can sort of flush that out with the accountant.
And in terms of the importance of that advice, what happens if you get it wrong in super? Let's just play devil's advocate here. Someone goes and makes those additional contributions to get themselves up to that level where you're below the tax threshold. What happens if you need to get the money back out? Is it a scenario where once it's in, or could someone turn around and say, look, I need some advice on how I can withdraw that money from super?
Yeah, so if you exceed the concessional cap, then the money will basically be added back onto your assessable income. So that's how from a pre-tax point of view, contribution. Non-concessional, bigger issue. There's significant penalty tax. From the government's point of view, the contribution caps are there for a reason, that we have more people retiring than entering the workforce. They want the system to be, money to be drip fed in over a person's working life. When I first started in advice in 2008, there was, maybe even just before that, there was this golden opportunity of, it was unlimited. Then there was 1 year of, you could put up to $1 million before these caps started reducing. And it's only been sort of going one way ever since then.
It feels like there's a new piece of legislation every couple of years in this space. And
what did Kerry Packer used to say when if you introduce a new one, repeal an old one?
Yeah, something like that. Yeah, I think we're going to see more red tape than less, though, because
I suspect.
Given the government's balance sheet, it's more than likely they're going to use different levers in the space to get more capital back on their side of the ledger. Are there any other forecasted legislative changes outside of the changes to CGT, or do we have any other sort of stepped increases in contributions that people have to make over time, or is the 12% it for now?
The 12% that will they'll bet in the 3 million cap, or 3 million plus. The other aspect on that is there's been a lot of lobbying to get that indexed. As at now, that's not the case. So that will be a static $3 million unless that ever changes. So with compounding of assets, we may find people get there a lot quicker than maybe they think, depending on accumulated balance and how long until retirement, things like that.
One final question on the CGT thing. Is that going to be calculated on net assets or total valuation in an SMSF?
So it's member-based. So if the portion of assets that, husband and wife have, that could be $4 million, but maybe 3 million is attributed to the husband, 1 million is attributed to the wife, or it could be 2 and 2. So if it's 2 and 2, they don't have that issue. So the actual balance of the fund is different to the balance of each individual member.
And I get the balance question, but my question is more along the lines of, if they have an LVR on a property, are we looking at the rise in the net? The net?
Yeah.
Okay. So if someone looks at this and they're contemplating buying an investment portfolio or properties, they might have $1 million within super.
Yep.
They can then go get a 70% LVR, and then they can run out there and they can get some properties, and they're not going to come into trouble until that LVR gets to a point where the equity's worth
correct
3 mil.
The 3 mil.
Yeah. Well, mate, thanks very much. Is there anything else that you'd like to talk about super while I got you here? Because for our listeners, we are looking at a series of discussions around financial planning and the different elements of financial planning. But is there anything else you'd like to discuss with our listeners about super?
Yeah, I think the only other thing I'd like to discuss is the retirement planning. And what a lot of the work that we do at River is to try to help people to give them that roadmap and help alleviate the intangible aspects and maybe fear that they have going into retirement. So the ASFA standard, so Australian Association of Super Funds, have a retirement standard couple, no mortgage, about $74,000 a year. So on paper, most people might think that's okay. One of the caveats in there is that that only includes overseas travel once every 7 years. So you can probably back me up on this, Kieran, with your clients. I'm sure a lot of your clients want to go overseas more than more frequent than every 7 years. So
yeah, when we were looking at those costs, those guidelines in terms of income, in this country, costs are going up, so they're not going very far. So having a trusted advisor that can provide you with robust wealth management solutions, the right advice in terms of how to build your super fund is becoming more and more critical, because that's that one safe haven that when you retire, it's your nest egg and it's going to fund your lifestyle as a go forward. To be frank, I thought 74,000 per person might have been a bit light, especially if you're living in Sydney's eastern suburbs or the inner city suburbs, because you've got coffee's $6 a cup now. I remember when it was $3 or $4 not too long ago. Everything's more expensive, rent's more expensive, interest rates are higher. So we're in an economy where costs are going up. So that retirement planning is so important. When you're sitting down with your clients, is that something they're looking at? They're going, okay, well, my cost of living today might be $120,000 as a family group, but where do we see that in 2, 3, 5 years, and what are the strategies we use to get there?
Yeah, no, I had a meeting this morning with a client, and we looked at what type of lifestyle they'll lead in retirement. We looked at their overall net income as at now. So they want to retire in sort of 2 years' time. So we're looking at, well, what are you generating net of tax now? And what differences will, in lifestyle would you have now versus retirement? So there's sort of some things get added on, some things get taken off, work-related expenses get taken off. There's more liberty, more time to travel. So habits change, objectives change. But quite often we see that being somewhat close to what they're spending now. Where we would question it to be unrealistic if someone was to try to reduce their income by half, 40%. I think it's pretty unreasonable to think that you could, your baseline expenses, your fixed costs, not even taking into account your variable travel, entertainment type of things, but your fixed costs are, sort of at a level. Particularly in Sydney, there's not much wiggle room there. So,
No, I think in terms of retirement planning, longer dated assets. I'm just going to speak from my own experience. When I set up my SMSF, I was looking at the longer dated investments because I'm not going to need to access it for 20 years or more. And that makes sense with a lot of the products we're seeing for wholesale clients. And a lot of that's available to retail as well on the various platforms that we invest across too. So there's a lot of variety and options for the clients. But when do you think it is the best time for a client to engage with someone like you to start making their retirement plans?
Yep. There's probably better and worse times. The right time is sooner the better. At least if you can get an assessment done whether it is the right time from a professional, whether to act now or not. That will give you clarity as to where you are, what you need to do. So I would say sooner rather than later. Life does get busy. We tend to sort of put these things to the side. I'll come back to it later. A classic example of that would be on the estate planning front, which we're trying to do a lot of work in a way to be the facilitator for clients to get the outcomes that they need. Because I've had clients for maybe up to a decade that don't act, and we talk about it every review. We really need to do this, we need to do it, but it's on the pile of list to do, but it's buried at the bottom somewhere. So there's no time like now. My advice would be to act sooner rather than later. The opportunity cost of not acting, the reality is you just can't turn that time back. So if you leave your run too late, particularly for younger people, the headwinds that they'll be facing into is larger debt, cost of living, potentially having families later in life, being able to be, set themselves up financially. So, the kids are, still maybe dependent when, maybe when our parents were kind of turbocharging their supers because we're all, out of the house and expenditure went down.
Mm-hmm.
So the dynamics change. So you can argue that with decreasing tax revenue, maybe less support from the government, that you need to act sooner than later.
Yeah, I think the best time is often now.
Yep.
Because you can't turn back time, and the sooner you start planning, the better.
Yep.
Well, that was great, mate. Thank you very much for coming on.
Thank you for having me.
If someone wanted to find you, if a client or a listener wanted to find you, how could they find you?
Yep. Anyone's welcome to engage with me through the River website, or I'm on LinkedIn.
Mm-hmm.
On the River website, you'll be able to find my contact details there. That'd be the best.
Yeah, well, thank you very much. I hope that was informative for everyone, and we'll be back with another series with Scott shortly. Thank you.